Among the major cryptocurrencies, Cardano stands out because it's the most volatile of the bunch. It tends to go up and down much more than the rest. At one point, when we look at Cardano's historical price movements over time, from top to bottom, it crashed by 98%. But that's what might make it attractive, because if we time this right, the recovery can also be a multiple X return. And so already based on that historical pattern, it's probably not the best to just buy and hold the asset. It might make more sense to try to find an indicator that historically worked well to figure out if we are going up or down. Now what we've got over here, that's an overview of 365 simulations of trading Cardano. On the x-axis, we've got the moving average duration. On the y-axis, we've got the annualized performance. The best moving average for Cardano is the 24-day simple moving average. If you bought and held Cardano over the time period, you would have turned $100 into $1,200. If you followed the trading strategy, you would have gotten more than $70,000. So from 34% per annum to 117% per annum. Let's get into more detail. Let me show what exactly the strategy is. And let's see how consistently this works over time. This result over here is still without leverage. Maybe it makes sense to even lever this up. So the idea is straightforward. We want to buy whenever the price is above a moving average, and then we want to sell whenever we are below. We are not betting on falling prices, we simply just go in cash. And we want to find out what can we do in order to avoid those massive crashes that Solana sometimes faces. And instead, we want to be mainly in the market as the price has those multiple X returns. So what moving average duration is actually the best for Solana? Again, the answer is the 24-day simple moving average. And that's then the kind of performance that the simulated trading gives us. We've got the price of Cardano in gray, and we've got the portfolio line in blue. This is a logarithmic scale, and we can see that we outperform buying and holding Cardano simply by being in cash when the price tends to go down. What we see at the bottom, that's the portfolio measured in Cardano. So how much alpha are we generating over time? So what are the numbers here? The maximum drawdown, as said, for just buying and holding Cardano was 98%. Following this trading strategy, because we sometimes sell, gave us a maximum drawdown of only 71%. So not only is this generating more return, it also gives us less of a drawdown. The volatility of our portfolio is lower, so the portfolio fluctuates less than the Cardano price itself. The beta is of course lower as well, and that's achieved by making 276 trades. Now here's something interesting. The win rate is only 20.3%. So how is it possible that a strategy tends to outperform buying and holding when the win rate is that low, when almost 80% of the trades are actually losing trades? The answer is by trading according to moving averages, we are betting on an already established trend. But prices are very fluctuating in the short term, and so a trend doesn't necessarily have to be established once it crosses the moving average. So really, this here underrepresents the volatility. In reality, things rather go up and down quite aggressively. And if we then come with our moving average, we might every now and then get those bad signals, and then suddenly we sell low in order to buy back in high again. We sell low to buy back in high again. And those kind of bad trades, that's what's pushing down the win rate. But fundamentally, that doesn't seem to be a problem, because while 80% of trades are bad, they on average only lose 3.7%. So we get a short-term fake out. However, if a trend has been established and we keep a position open for longer, then we win on average 117%. And again, that's by following the 24-day simple moving average. The average trading duration is 10 days, but our gross profit divided by our accumulated losses is 8 times larger. Just have a look at the worst year of that strategy, minus 55% versus Cardano, minus 94%. Now 117% per annum looks nice. It's more than a doubling every year, but maybe we can spice this up a little bit. That's where leverage optimization might become interesting. Here is buy and hold, so that's the dotted line. 1x following that strategy brings us more than double the return, right? More than 100% per annum. But when we lever this up from the 1x to the 1.75x, we can increase our return a bit. Once we go too large on the leverage though, then the movements to the downside are very hard to recoup, and then we get a much worse risk to reward. And so what happens once we add a 1.75x long leverage to the situation? The answer is we get an annualized return of 153%. Again, versus buying and holding only 34%. However, the maximum drawdown also increases substantially. Without leverage, we were at 71%. Now we are at 93%. That's barely doable in real life, right? If you invest $100 and temporarily you're down to $6.50, are you really continuing with that strategy? It's rather unlikely. So even though we might be getting more return with a 1.75x, the drawdown is so large that it's not really feasible to execute that in real life. And so have a look at the portfolio line on 1.75x leverage over here. We do see that because of the recent drawdown, it's very hard to recover and come to a new all-time high. When we reduce this to 1.5x, it already looks a bit better, but of course our annualized return goes down. And if we just have 1x, we are at the all-time high. And yes, the return is lower, but the drawdown is also much more reasonable. And so while it might be enticing to increase potential returns with just a bit of leverage, it seems to not really be worth it because the drawdown simply expands too much. Simply buying and selling Cardano based on the best moving average seems to be the best strategy. And so here we go. This is Cardano with the 24-day SMA with the best moving average. And have a look at this. This is a buying signal. We just went above the moving average. But we can already see the potential problem with the strategy. Even though long term it outperforms buying and holding very well, we also now see live how 80% of the signals are bad. We get our fake outs, we go above the moving average just to get disappointed again. But when the signal actually works, we can more than double our stack. Just have a look at this. Here was a nice breakout and this gave a rally of 200%. And even if the rallies aren't always that large, 34% here and there isn't too bad either. But again, 80% of signals are bad, and so this can just be another fake out. We can also have a look at this relative to other altcoins. So this is now the Cardano price divided by the market cap of all altcoins that are not in the top 10. So that's the others market cap. That way we can figure out how is Cardano long-term performing versus most other altcoins. Unfortunately, the long-term trend is not that great. We tend to rather underperform. However, we are also at the lower end of that trading range. And it looks like we either buy during bottoms like this, or we try to catch a wave like this very, very quickly. But the rallies are much, much quicker in Cardano than the declines. Maybe the asset simply gets short squeezed. Too many people are betting on falling prices, and then the market makers short-term squeeze those short speculators to make some money off liquidations. And maybe at the current price level, there's now enough short investors that potentially could get squeezed again. Here is another chart, and this again explains that holding most altcoins long-term versus Bitcoin is not a good idea. Bitcoin tends to outperform most altcoins long-term, and so we have to treat Cardano because of its volatility and because of its long-term underperformance versus Bitcoin as a short-term speculative asset. It's not something to just buy and hold over many years, at least if history is any indication. But again, every now and then we get those interesting rallies. And while this might not be the absolute bottom, there's always a chance we see another sell-off. We can manage that risk simply by following the 24-day SMA. If Cardano was to fall by only another 5% from here, we might as well quit the position. And when we do decide to enter here to bet on rising prices, then it's important to take profit at some point, because those rallies in Cardano don't last forever. And again, the last time when we crossed that 24-day SMA, it was the perfect time to mark the eventual downfall subsequently. Then Cardano continued to rather sell off again. So So that's just what the data says. I'm not saying that I know what's going to happen in the future. I just like to use trading rules. The fundamental idea is that we don't want to bet on the news of the day. We just want to bet on the structure of the market. An approach that worked in the past might work in the future as well. It's better than just random guessing, at least. If you got some value out of this video, feel free to give it a like. Feel free to also subscribe. I publish videos regularly. Feel free to also check out the premium membership. This is where you also get access to this tool and where I share my personal trades as well. See you next time, and thanks for watching. Cheers.